Imagine you have a hen that lays golden eggs. Every month she lays a shiny egg. Now you have two choices. Use this egg and spend it quickly. Save the egg and use it to buy another chicken. If you choose the second option, in a little while you will have two hens laying golden eggs. Then you do the same thing again and again. In time you won't just have a chicken, you'll have a whole chicken coop. This is how it works: dividend reinvestment. Instead of taking the money the company pays you, the golden eggs, and spending it, you use that money to buy more shares, more chickens. These new shares will also pay dividends, and so begins what we call snowball effect. The more time passes, the higher your income becomes. It starts small, but after a while, it becomes huge. Remember the story of the hen that lays golden eggs. Now let's talk about a real hen, or rather aerial company that does exactly that in the investment world. The 3M. 3M is a company that makes a little bit of everything from adhesive tape to medical equipment. But the most incredible thing is that it has laid golden eggs, i.e. paid dividends, for over 60 years in a row. And not only that, she increases these payments every year. Now imagine the following. You put $1,000 in 3M stock and sit down to wait. After 25 years, if investing dividends, your money can turn almost $24,000. But if you do not reinvest, stay with something close to $6,400. See the difference? It's like two friends who plant the same seed. One waters it every day and plants the fruit again. The other only eats the first fruit and stops there. Who will reap more in the future? That's the power of time, plus reinvestment. And 3M is just one example. There are other chickens in the market that do the same magic. Now that you understand how reinvestment can multiply your earnings, here comes the even more interesting part: dividends that grow over time. It's not just that you earn more because you have more shares. It's that companies also tend to increase the amount paid per share over the years. In other words, even if you stop investing, what you have already purchased continues to yield more and more. In the example of $1,000 invested, after 25 years of reinvesting the dividends, you would be receiving about $620 per year only in payments. This means that each year you would earn more than the amount you put in at the beginning. Literally, your money works for you. And the best part, this income keeps growing if the company keeps increasing its dividends. It's like a salary that gets a raise every year, even if you're doing nothing more than maintaining your investment. So far, we've talked about what happens when you invest just once. But what if you decide to invest every month constantly, as if it were a bill you pay to your future self? Let's imagine that you invest $1,000 per month for 25 years. At the end of this time, you will have placed a total of $300,000 from your pocket. Now comes the surprising part. If you reinvest dividends, this value can be transformed into $2.3 million. If you do not reinvest, the total is around $877,000. Even adding up all the dividends received over time, without reinvestment, you would still be left with more than $1 million less than I would have reinvested. I.e., investing with discipline and reinvesting dividends makes all the difference. It's not just about investing more, it's about letting time work in your favor. Now that you've seen the huge difference between investing once and investing every month, let's talk about what perhaps interests many people the most: how much you can receive in dividends per year, i.e., passive income. That money that goes into your account even if you are no longer actively working. If you had made that monthly investment of $1,000 for 25 years and reinvested the dividends all the time, at the end of that period, you would not only have a net worth of more than $2.3 million, you would also be receiving $157,000 per year in dividends. Yes, you read that right, $157K per year. Only with dividends. This amounts to more than half of what you invested in total, coming every year automatically, without having to sell any shares. Now think about it. How many people in the United States can live very well on an income of $157,000 per year? Many, right? And even better, this income tends to grow over time because good companies increase dividends over the years. Now, what if you had made the same contributions but did not reinvest the dividends? You would still have a reasonable result with about $62,000 per year in dividends, which is no small feat. But compared to the $157,000, you can see how reinvesting from the beginning has a huge impact. That's the magic of dividend snowball effect. The more you maintain the discipline of reinvesting, the more your earnings grow and the faster they grow. The value of your assets increases, but what really changes your life is the income that he begins to generate on his own. And the most impressive thing, all of this was possible only with constancy, patience, and reinvestment. Now that you've seen how much you can earn in 25 years, the natural question is, what if I continue for longer? This is where the snowball effect shows its full power, because the longer you let this machine run, the more it accelerates, and the numbers start to grow in an almost unbelievable way. Let's continue with the same example. Investing $1,000 per month and reinvesting all dividends. If instead of stopping at 25, you continue for 30 years, your annual dividend income jumps to $398,000 per year. If you have patience and keep going until 35 years old, this annual income exceeds $1 million per year in dividends. What about total equity? At age 30, approximately $5 million accumulated. At 35 years old, more than $11.7 million. Now compare that to someone who has not reinvested anything over time. The difference at the end of 35 years is almost $10 million in the accumulated total and over $800K difference in annual dividend income. These numbers may seem too big to be real, but it's simple math. You're adding consistency, patience, and compound interest. Most people underestimate what they can achieve in 30 or 35 years because they live thinking about the next 2 or 3. But time is the investor's greatest ally. He turns pennies into fortunes quietly, without haste, but without fail. And it's important to highlight, even if you stop contributing after a few years, what you've already built continues to grow. If you stop investing, but continue reinvesting dividends, the machine keeps running. Your assets keep growing. Your passive income keeps growing. The secret is to let time do the work you don't need to do. By now you've realized that reinvesting dividends makes a big difference. But what may not be entirely clear is that this difference does not grow linearly. It grows exponentially. This means that the more time passes, the gap between those who reinvest and those who do not becomes greater. Let's take the video data as a basis again. After 35 years, who invested $1,000 per month and reinvested all dividends with a net worth of about $11.7 million and receives more than $1 million per year in dividends? Who made the same contributions but did not reinvest, ends with only about $2 million to $2.5 million, depending on how you spent the dividends, and an income of approximately $200K or less per year. In other words, the investor who reinvested dividends had almost 5 times more equity and 5 times more passive income, and this without having to do anything radical or take extreme risks. He just let time act and reinvested what he received. This is the main point. It's not about how much you invest per month, but what you do with the income you receive along the way. Whoever takes the dividends and spends them limits growth. Whoever takes the dividends and reinvests them accelerates growth. And as the years go by, the difference grows. It's like a ladder. At first the steps are small, but suddenly you realize that you're climbing ramps, not steps. This is the real snowball effect in action. After everything we've seen, the values that grow over time, the dividends that multiply, the absurd difference between reinvesting or not, comes the most important question of all. When is the best time to start? The answer is simple: as soon as possible. And it's not just Generic advice. It makes all the difference in the results. The sooner you start, the more time your money has to grow. And as we have seen, time is the most powerful ingredient in this recipe. For example, if you start at age 25, investing $1,000 per month, you can reach age 60 with over $11 million and an annual income of $1 million or more. But if you start at age 35, with the same monthly amount, that number drops dramatically. And if you only start at 45, even if you invest a lot, you may not have enough time to reap the snowball effect with the same strength. It's not about being perfect. If you haven't started yet, the best day to start is today. And if it has already started, keep going and don't stop. Reinvesting dividends isn't a magic trick. It's a quiet, patient, and extremely powerful strategy. It doesn't make any noise, but it can completely transform your future. Even if you start small, what really matters is taking the first step and maintain consistency. Because a small snowball at the beginning turns into an avalanche over time, and those who invest early reap sooner. Now that you know that time and reinvestment work miracles, it is important to understand another crucial point: the discipline to invest regularly. Investing in something every month, even if it seems small, can make a huge difference. Think of it as a habit, like brushing your teeth or exercising. It may seem simple, but if you stop for any reason, all the progress you were making can slow down. The beauty of discipline is precisely in maintaining the rhythm, even when the market is unstable or when the urge to spend money appears, because it is precisely in these moments that continuing to invest makes all the difference. Additionally, investing regularly helps to dilute the risks. You buy shares at different prices, which prevents your money from being tied up in just one bad market moment. Therefore, what makes investment a success is this combination. Start early, invest every month, reinvest dividends, and be patient. It's not an easy path for those who want quick results, but it's the safest and most proven path to building real, sustainable wealth. One of the great advantages of investing in dividend-paying stocks is that you can make money without having to sell your shares. This means that you can hold on to your shares for years, even decades, and still receive a steady income as if the company were paying you a regular salary. To better understand, let's think about what happens when a company pays dividends. Dividends are a portion of the company's profits that it decides to distribute to its shareholders. In other words, when you buy a share, you become a partner in that company and, as a partner, you are entitled to receive a share of its profits. This amount goes directly into your bank or brokerage account without you having to do anything. This is very different from selling a stock. When you sell a stock, you are giving up that part of the company. You receive the money from the sale, but you give up an asset that could grow and generate more profits in the future. Additionally, when you sell, you may have to pay capital gains taxes, depending on the amount of the sale and how long you held the stock. On the other hand, when you receive dividends, you continue to own your shares, which can continue to increase in value over time. In other words, you earn money in two ways: from the appreciation of the shares, if the price goes up, and from the dividends that the company pays regularly. An even smarter step is to reinvest those dividends. This means using the money you receive to automatically buy more shares of that same company or other companies that also pay dividends. Over time, you will increase the number of shares you own, which will make your future dividends grow even more, because more shares mean more dividends received. This process creates a powerful cycle. You receive dividends, use these dividends to buy more shares. These new actions generate even more dividends in the future, and so on. This cycle is the essence of what we call passive income. That is, money that goes into your pocket without you having to actively work for it. And the coolest thing is that this income can grow over time, especially if you choose solid companies that increase their dividends regularly. Therefore, Investing in dividend-paying stocks is a smart way to make your money work for you, generating a continuous and growing source of income while you maintain ownership of your investments. It is a strategy that helps you build wealth in a safe and sustainable way, harnessing the power of time and compound interest. Investing in dividend-paying stocks isn't just a way to make money for yourself now, it's a powerful strategy for building a lasting financial legacy for your family. When you reinvest your dividends, your wealth grows and grows. Over the years, your wealth can grow to such a large value that the dividends it generates become a steady source of income, not just for you, but for future generations. Imagine that you start investing today by buying stocks that pay regular dividends. As these dividends are reinvested, the number of shares you own increases, and consequently, future dividends also increase. This creates a cycle that over decades turns a small amount of money into a veritable money tree that continues to bear fruit year after year. This exponential growth means that even after you're no longer actively investing, your money continues to grow and generate income. This can be crucial for helping your children pay for college, buying a home, or even ensuring a comfortable retirement for them in the future. Furthermore, this wealth can be passed on to your heirs, meaning your family will be able to enjoy financial support for a long time to come. Many investors see dividends as a way to create a family fund, which helps protect against financial contingencies and offers greater peace of mind for future generations. Another important point is that this type of investment helps educate your children about finances and investing. When they see results over time, they learn the value of money, patience, and financial planning, skills that can transform their lives. Therefore, dividend investing is not just about making money today, but about building a solid foundation for your family's future, creating truly sustainable and growing wealth that can last for generations. Now that you understand the power of dividend investing, the exponential growth it can generate over time, the passive income it can provide, and the financial legacy it can build for your family, the most important thing you need to know is, don't wait any longer to start. Many people think that they need to wait until they have a large amount of money to invest, or that they should only start when the market is good. This is a trap that many fall into, and that can greatly delay financial success. In reality, the biggest secret is to start as soon as possible, even with little money. Every dollar you invest today has enormous potential to grow, and the longer that money has to grow, the greater the result will be. This is the effect of compound interest, that snowball effect that at first seems small, but that over the years turns into an avalanche of wealth. For example, imagine two people. One starts investing $200 per month at age 25, and the other starts investing $500 per month at age 35. Although the second person invests more per month, the first person who started earlier will probably have a larger net worth in the long run. This is because the time the money is invested makes a much bigger difference than the amount you invest each month. Furthermore, investing in dividend-paying stocks has another advantage. You start receiving passive income, an income that does not depend on your work. This income can be reinvested to further accelerate the growth of your assets or used to improve your quality of life. The ideal is to create the habit of investing a fixed amount every month, even if it is small. This way, you take advantage of the power of regular investing, which helps to smooth out market fluctuations. Sometimes you buy more expensive stocks, sometimes cheaper ones, and maintain financial discipline. Another key point is to reinvest your dividends. Instead of spending this extra money, you use it to buy more shares. This increases the number of shares you own, and consequently, the dividends you will receive in the future, creating a virtuous cycle of growth. It's also important to remember that investing is a marathon, not a sprint. Results come over time. And patience is your best friend on this journey. If you stay focused and disciplined, you'll eventually have a steady and growing source of income that could even replace your salary. What's more, by starting early and being consistent, you can not only improve your financial situation, but you can also create a legacy for your family. The wealth you build can help your children, grandchildren, and future generations have more security and opportunities in life. Ultimately, the best time to start investing was yesterday. The second best time is now. It doesn't matter how old you are, what your current income is, or how much you know about investing. The important thing is to take the first step, learn along the way, and stick with it. So my advice to you is, get started today. Make a simple plan, start with what you can, stay disciplined, reinvest your dividends, and let time work in your favor. This is the safest, smartest, and most accessible strategy to build true wealth, ensure your financial independence, and provide a peaceful future for you and your family. Throughout this conversation, we've seen how investing in dividend-paying stocks can be one of the smartest and most powerful strategies for building wealth, ensuring a steady passive income and creating a financial legacy for you and your family. Each of the points we've explored reveals a fundamental part of this process, which when added together, form a solid path toward financial independence. First, we understand that time is an investor's greatest ally. The sooner you start investing, the more time your money will have to grow through the effect of compound interest and dividend reinvestment. The snowball metaphor helps to visualize this process. Small amounts at the beginning, over time, turn into large amounts thanks to exponential growth. Therefore, patience and discipline are crucial for those who want to take full advantage of this strategy's potential. We've also seen that reinvesting dividends is key to accelerating this growth. Instead of using dividend money for immediate spending, it's best to use it to buy more shares. This increases your stake in the company, which generates larger dividends in the future, creating a virtuous cycle of steadily increasing passive income. It's this cycle that turns a modest investment into a true source of growing cash over time. Furthermore, regular contributions, even small ones, are essential. Investing a fixed amount each month helps to dilute market risks and maintain financial discipline, which are essential aspects for long-term success. You don't need to have a lot of money to get started. What's important is consistency and determination to keep investing even when the market fluctuates. Another key point is the difference between simply receiving dividends and reinvesting them. When you keep the dividends and reinvest, you are buying more shares that will generate even more dividends, growing your wealth in a sustainable way. Without reinvesting, even though you have the dividend money in hand, the total growth of your wealth will be much lower. We also talked about the advantage of receiving dividends without having to sell shares, which guarantees a stable source of income without reducing your invested capital. This is especially important for those who want to keep their assets intact and still enjoy a growing passive income. Finally, we highlight the power of dividend investing to create true generational wealth. By building a solid wealth that grows over time, you can ensure that your children, grandchildren, and future generations have financial security, opportunities for growth, and a foundation to thrive. All of this reinforces a simple yet powerful message. Start today with what you can. Invest regularly in dividend-paying stocks, reinvest your earnings, and be patient. This combination of factors is the recipe for building a stable, sustainable, and prosperous financial future. By following this strategy, you will be on the path to not only improving your quality of life, but also achieving your dream of financial independence, where money works for you, generating passive income that allows for more freedom, security, and peace of mind. Investing in dividends is therefore more than just a financial technique. It is a philosophy of life based on patience, discipline, and long-term vision, capable of transforming your future and that of your family.